Some experts believe until the coalition government reforms the country's economy, India will fall far short of its potential. But I'm speaking to BBVA's senior economist to get his take on the situation. Sumedh, during the global financial boom of the mid-2000s, investors indiscriminately dumped cash into fast-growing countries, and India's shortcomings were easily overlooked. But have the fundamentals really changed so markedly, would you say?
India's impressive near 9% average growth during the mid-2000s was in fact anchored by robust fundamentals, in particular rising investment to GDP ratio, a benign inflation of around 5%, and shrinking current account and fiscal deficit. Furthermore, productivity gains from the structural reforms in the industrial sector as well as the financial sector during the mid-1990s, post the 1991 crisis, actually put India on a very strong footing. However, the rebound post the crisis was in fact led by excessive government spending, even as monetary policy was tightened to address inflation risk. So, the persistent fiscal slippages emanating from rising food and fuel subsidy outlays reduced domestic savings and undermined efforts to narrow the current account deficit. And what in turn these high current account deficits and the fiscal deficit did was it crowded out private investment and raised external vulnerability risks. Furthermore, persistent inflation amid supply bottlenecks and loose fiscal policy, kept Reserve Bank of India from lowering interest rates.
Okay.
So, in fact, the fundamentals of India when it entered the crisis were actually quite robust.
Despite the apparent need, many don't expect the current coalition to make any politically difficult changes until after national elections next year. Today we have an update on trade balance, imports and exports. How damaging could delays in action be for the Indian economy longer term?
Despite political bottlenecks and being a pre-election year, since September 2012, the government has been, taking steps to revive growth through a broad set of policy measures, which actually aim to achieve fiscal stability, stimulate investments, correct external imbalance, and improve governance. Although the part of these measures are long-term, over a short term, they have actually done little to regain investor confidence and revive the investment cycle. The key, we believe, is to undertake bolder structural measures, which would include sharper diesel price hikes, unclogging food and raw material supply bottlenecks, and also expediting stalled infrastructure and mining projects. So in this context, the government's commitment to bold reforms is positive, although a risk of inaction, which we believe would significantly impact the long-term growth potential, which we estimate to still be at a respectable 7.5%. So a shorter term, however, we expect the growth momentum to weaken further in Q3 from a decadal low of 4.4%, which it hit in Q2. So the near term or the shorter term downside risk to India's growth certainly exists. Although the longer term, we believe that India's growth potential remains at around 7.5%.
The rupee recovered after dropping some 16% against the US dollar due to positive sentiment generated after payrolls data and the measures taken by the RBI. According to some, the currency could strengthen to around 63 per dollar before resuming its drop, however. But what is your outlook, Sumedh?
The fast pace of rupee depreciation which we have seen since July actually mirrors the fading investor confidence on India's policy response to tackle its deteriorating growth outlook. In this context, the recent strengthening in the rupee is, we would say, partly driven by favorable global factors and also aided by Reserve Bank of India's recent steps to bolster the rupee stability by deepening financial markets and easing external financing constraints. However, we believe these measures in themselves will not alleviate current currency pressures, but should help at the margin to encourage capital inflows and lift rupee demand. What we believe is that the arresting India's economic woes will take more than the RBI alone. In particular, the government will need to do its part to reduce the fiscal deficit in line with its 4.8% announced target for this fiscal year. And specifically, we need to take measures to expedite reduction in fuel subsidies, alleviate food and raw material supply bottlenecks, as I mentioned earlier. So looking ahead, we expect India's recovery to be long drawn, with downside risk to growth in the near term amid renewed inflation pressures. So overall, we expect the rupee to remain under pressure over the longer term.
Well, viewers, that's all from me and Sumedh for the moment. The Dukascopy TV team has a full bulletin of exclusive interviews to bring you today, so please do keep clicking back. Bye for now.